We asked a pressing question to our investors. What would you like to do with your portfolio with Nifty at 18,000 levels? Buy, sell, hold. What is your plan of action? What came back to us was exhilarating, to say the least. See it for yourself.
With Nifty at 18,000, the question that most of us have in our minds is, should we be deploying the money into the markets or should we hold on to cash now? Looking at the scenarios that are playing out, India is in a very sweet spot. Our GDP is expected to be at 7%. Banks have delivered stupendous results in Q2. Inflation is almost peaking and would only now be going down. And foreign investors are all queuing up to come into India. It is believed that about $25 to $50 billion could come in a very short time now. Plus, the China plus one factor is playing out, and many investors are pulling their money out of this country and coming towards other countries like India. So these are the positives that we can see for India, and I therefore feel that we shouldn't take such chances by holding on to cash at this moment. At the same time, there is a negative side also that is playing out. The Western world is in doldrums, and their economies are expected to go into recession. So looking at it from that perspective, these markets could get impacted here as well. So since we don't know how exactly it would play out, it would be better to deploy some portion of the cash right now, maybe 30% of the cash in the markets right now, and over the next 1 year, do a SIP in stocks or in mutual funds, whatever it is, and iron out the ups and downs that can happen in the next 1 year.
Nifty is trading at about 18,000 levels now, and I am sure it will touch about 20,000 by next Diwali 2023. Reason being, Indian economy is growing very, very fast, and result of most of the companies are showing tremendous growth. So my expectations are like this. And if somebody has a long-term horizon, he should definitely buy even at this level so that you can get the level of 20,000 by next year.
In my personal view, the market is just started to recover, and maybe some of it is pulled up because of Adani and Reliance. But I think that India economy is now one of the most vibrant economies, and what I understand from various research articles that FIs will be heavily investing in next 2-3 months. So I think we should selectively sell and buy. There are opportunities for both. For example, IT, Wipro and Birlasort and others are available at a very cheap valuation. So we can buy those, and we should sell the scripts which are already overvalued or where the performance is not good, and we think by research that they will not give huge returns in the future. So I think there is a huge opportunity for both buying and selling, and but we have to do proper research on a regular basis.
The opinion on the street is a polarized one, where one sect believes that 18,000 levels are very attractive levels to enter the markets, given what lies ahead, as you saw with the views of the investors whom you just heard in the videos. And then there is the other sect that believes that 18,000 levels are too stretched and use the term, markets are expensive now. They believed markets should have corrected to 14,000 levels when Nifty was at 16,000. And for sure, they continue to voice their views that near these ever-time high Nifty levels, the markets are too expensive now. We will set the truth in motion by answering the million-dollar question in 3 parts. Part number 1. Why was Nifty expected to come down to 14,000 from 16,000 levels? Part 2. Why did Nifty instead go up from 16,000 to 18,000 levels? Part 3. Why we believe Nifty will go up from 18,000 to 36,000. At the end of this special episode, you will know what to do with your portfolio with Nifty at 18,000 levels. Let's begin this special Third Umpire episode, an initiative brought to you by Research and Ranking. Let's understand the first question, which is what baffles everyone. Why was Nifty expected to come down to 14,000 from 16,000 levels? With so much uncertainty and pessimism around, it was only apt for any logical investor to believe that Nifty will crash from 16,000 odd levels to 14,000 odd levels. But honestly speaking, this fall and this drastic dip that otherwise the global markets around have seen, as seen in the chart appearing on your screens, has not been the same bitter pill for the Indian indices represented by Nifty and Sensex. What's at the top of the chart are the indices Nifty 50 and Sensex for the YTD period. Again, coming to the reasons why people felt the indices in India too shall crash could be contributed to the following factors. Mainly, the worries of a global recession and geopolitical crisis weighed on the sentiment. Markets were downbeat because of the bleak prognosis for the global economy, the intensifying geopolitical unrest, and the looming rate hike concerns, which gave investors the means to sell stocks at any time. Following aggressive monetary policy actions taken globally to prevent an increase in inflation, financial conditions have tightened. Due to this, financial markets are now more volatile and the dollar has surged to a 2-decade high. In recent times, there were bold headlines and then there were concerning blogs, all saying something like this as an example. Investors were worried about how tightening monetary policy would affect economic development. At the same time, Mr. Powell made it clear that he is willing to raise interest rates as high as necessary to combat inflation, even at the cost of a recession. In short, global markets have been extremely volatile recently, as investors have worried that major economies will be pushed firmly into recessions before inflation is tamed. It was not just the average investor, but also the big guns who mentioned the R word and the fears of stocks plunging. Now, take this statement as an example. Nouriel Roubini, Professor Emeritus at New York University Stern School of Business, nicknamed as Dr. Doom for his prophetic visions of looming economic downturns, including an accurate prediction of the 2008 housing crash and the subsequent market crisis, has mentioned. Roubini warned that a confluence of factors including rising net national debt levels, supply chain issues, and a global energy crisis could bring together the worst of two historically bad economic downturns in the US. So amidst these gloomy headlines and discussion forums and TV channels screaming the recession word 50 to 100 times a day, it was but natural to assume that Nifty at 16,000 odd levels will correct to 14,000. But we can't blame the investors who fell prey to the headlines in print and on over-the-air media channels. So the belief that 16,000 will soon become 14,000 for Nifty has some sound logic and base. Let's admit that there was a fire somewhere and hence the smoke that choked everyone. But what transpired next is truly opposite for India and India alone. So that brings us to the second question then. Why did Nifty instead go up from 16,000 to 18,000? The answer to this is unique to India and India alone. India has a domestic, consumption-driven economy. Global events will naturally impact India through weaker export demand, but the Indian economy continues to be predominantly domestic-driven, with consumption and investments contributing to 70% of the economic activity. The global recession will have an impact, but it won't be as pronounced as perhaps other economies which are fully coupled with the globe. Global rating agency S&P said that even though the US and Eurozone are headed to recession, India is unlikely to face the impact given the not so coupled nature of its economy with the global economy. Macro factors in favor of the Indian economy have become providing optimism about its ability to weather the global storm. Growth impulses have become more widespread as demonstrated in high-frequency data from July and August, such as bank credit and IIP data. The core sector output of India increased to a 3-month high of 7.9% year-on-year in September as compared with an upwardly revised print of 4.1% year-on-year on August 2022. Now, see this chart appearing on your screen. The government's aggressive capital expenditure investments are boosting the core sector's growth. Industry and service activities remain robust as indicated by the recent Purchasing Managers Index PMI for India. The October PMI data pointed to an improvement in the overall operating conditions for the 16th straight month. Government capex, which has a multiplier effect on the economy, is on a strong footing, with private capex slowly catching up. Capacity utilization has improved and credit growth is at double-digit levels. The rise in manufacturing capacity utilization inching towards the 75% level also indicates a positive future activity. On an encouraging note, GST collections too have remained strong. In October, GST collections rose to 1.51 lakh crores, the second highest level since the rollout. Record GST collections demonstrate an improvement in economic activity. Government finances are also in order. Despite capital spending rising and higher subsidy outlays, the centre's fiscal situation is in a comfortable situation supported by strong tax revenues and non-tax revenues crossing 50% of the budgeted estimate in just the first half of this year. Broadly speaking, so far, the government's finances seem to be in order. Given the current macroeconomic headwinds, see the table on your screen appearing now. Forex reserves are ample to withstand any external pressures. Bad loans were a massive problem that was plaguing the banking sector in India, and the need of the hour was to identify the defaulters. By forcing an asset quality review on bank, the RBI did precisely that. Since then, banks have been cleaning up their books, which can be seen in the gross NPA and the net NPA ratio declining. We believe the Indian banking system is resilient and there are visible signs of asset quality improvement on the back of years of corrective actions. To further accelerate the process, the National Asset Reconstruction Company NARCL is also underway. India's inflation is different from other economies. India's inflation problem is also domestically driven, in that a large part of the recent rise in the CPI print is because of surging food prices, which account for 40% of the inflation basket. In the global fight against high inflation, India's story stands out because both monetary and fiscal policies were deployed early. See this chart to understand how well India has fared in taming the inflationary pressures as compared to countries like the UK, the US, and Germany, and many others alike. India's fiscal policy measures are cushioning price pressure more, which sets it apart from other major economies. These include import duty reduction in edible oils, excise duty cuts on petrol and diesel, ban on wheat exports, duties on rice and steel exports, and purchase of cheaper Russian oil. The desire of global businesses to look for more resilient and cost-effective investment and export destinations and government initiatives such as NLP and PLI, among others, have helped India ride this tide of headwinds. So now you understand why the Indian indices did not go from 16,000 to 14,000, but instead went up from 16,000 odd levels to 18,000 levels that we see today. That brings us to the final question. Why we believe Nifty will go up from 18,000 odd levels to even 36,000 odd levels. Let us see why this too shall hold true in the foreseeable future. Number one, Chief Asia economist at Morgan Stanley forecasts that India will be the third largest economy by 2027, with its GDP more than doubling from the current $3.4 trillion to $8.5 trillion over the next 10 years. Number two, incrementally, India will add more than $400 billion to its GDP every year, a scale that is only surpassed by the US and China. Rhythm Desai at Morgan Stanley projects that India's market capitalization will rise from 3.4 trillion to 11 trillion by 2032, the third largest globally. Since the early days of the internet, businesses all over the world have outsourced to India services like software development, customer care, business process outsourcing. However, the notion of India serving as the world's back office is currently gaining new impetus as a result of tighter global labor markets and the advent of remote work arrangements. Number 5. According to Morgan Stanley, in the coming decade, the number of people employed in India for jobs outside the country is likely to at least double to over 11 million. And the estimates for global spending on outsourcing could rise from 180 billion US dollars per year to around 500 billion US dollars by 2030. Point number 6. Notably, the number of global in-house captive centers that opened in India over the last 2 years was almost double that of the prior 4 years. During the 2 pandemic years, the number of people employed in this industry in India rose from 4.3 million to 5.1 million, and the country's share of global services trade rose 60 basis points to 4.3%. See the chart that summarizes what I just mentioned. Number 7. India is also poised to become the factory of the world as corporate tax cuts, investment incentives, and infrastructure spending will help drive capital investments in manufacturing. India is now making concerted efforts to attract investments to boost the manufacturing exports. These new factories and offices of the world will draw more employment into the formal sector and, more crucially, raise the productivity growth, creating a virtuous cycle of sustained growth. Manufacturing share of GDP in India could rise from 15.6% currently to 21% by 2031, and in the process double India's export market share. Number 8. What about India's diplomatic ties? India is living through the golden era of Indian foreign policy. For the first time, New Delhi is engaged everywhere and serves as a strategic crossroads of great power competition. India may well become a great power itself very soon. Number 9. What about India's FDI investment trend? A look at the year-on-year data suggests that FDI flows rose to the highest in FY 2022. India received the highest annual FDI inflows of almost 85 billion US dollars in FY 21-22. In the recent MPC meeting, RBI Governor Shri Shaktikanta Das also said FDI is at $13.6 billion in the first quarter of the current financial year as compared to $11.6 billion in the first quarter of last year. What about digital revolution that India is leading? The digital revolution led by India Stack will transform how India lends, pays and insures itself. India Stack may well be understood as Morgan Stanley report describes it as follows. The stack has 3 main layers: eKYC, which is biometric based KYC, DigiLocker, the cloud document storage, and eSign, the digital signing of documents, as well as multiple payment layers including the Unified Payments Interface, popularly known as UPI, the Aadhaar Enabled Payment System or AEPS, which facilitates direct benefit transfers and other payments, the Bharat Bill Payment System or BPPS for payment of bills, GST, goods and services tax, FASTag, highway rolls and tolls, and income tax. According to Morgan Stanley, the digital revolution has already changed the way India handles documents, invests, and makes payments, and it is also set to alter the way India lends, spends, and insures itself. In other economies of the world where private networks have become strong, India has built its public digital infrastructure, like with Aadhaar, a part of India Stack, a highly inclusive transaction-led model as we just saw, which can leverage this digital infrastructure to better match consumers and businesses, facilitate transactions, and also ease the cost of doing the business. India Stack has many uses, including a network for cutting credit costs, increasing loan availability, and making them more cost effective for both consumers and enterprises. Number 11. What about the promise of an increased consumption story for India? Additionally, consumers in India might have more money available. The income distribution in India may change over the following 10 years. And as a result, India's overall consumption may more than double from 2 trillion in 2022 to 4.9 trillion US dollars by the end of the 10 years. Non-grocery retail, which includes, amongst other things, apparel, accessories, leisure and recreation, and household goods and services, will see the biggest gains. What about India stressed with a clean energy transition? Although India will need to tap fossil fuels to meet its growing energy needs, an estimated 2/3 of India's new energy consumption will be supplied renewables like biogas and ethanol, hydrogen, wind, solar, and hydroelectric power. Clean energy and the energy transition are sectors where India is keen to take a lead, with Indian behemoths like Reliance Industries and Adani Group taking big strides. While the world has seen energy transitions before, what makes India unique is that the consumption of energy and its sources are undergoing a very sharp shift. Well, how does India fare with international trade agreements? India has entered a total of 19 trade agreements which are signed and in effect with various countries and blocs, including the 3 comprehensive economic partnership agreements that were signed in just the last 2 years with Mauritius, with the UAE and Australia. In addition, India has also signed 6 limited coverage preferential trade agreements which are also known as the PTAs. To sum up what Morgan Stanley has said about India, India has the conditions in place for an economic boom fueled by offshoring, investment in manufacturing, the energy transition, and the country's advanced digital infrastructure. These drivers will make it the world's third largest economy and stock market before the end of the decade. Well, there are countless reasons why India shall be the most favored destination for investors across the world, leaving aside the Indians themselves. We leave you with something that should cheer you up and help summarize what we have just discussed. Here's one story, as you see on your screen, that says India is an oasis of stability and an island of calm. Here's one more recent story that said India has emerged as a bright light economy amid global recession. Here's one more story that says risk to India's sovereign rating from external pressures seems limited. Above all, and everything kept aside, here's one recent story that sums it up in one headline. Remember where we started this episode? Why did 16,000 not drop to 14,000 levels for Nifty? Why did 16,000 become 18,000 so quickly? And finally, we've established the reasons why even 18,000 odd levels of Nifty will become 36,002 in the foreseeable future. With a wish to meet you soon and with prayers of well-being for your loved ones, coupled with happy investing times ahead, this is Sanjeev Anand wishing all the best of informed investor viewing ahead.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.